Dubai has aggressively positioned itself as a global wealth haven, drawing in billions of dollars by promising investors a frictionless, high-growth environment. The baseline numbers are persuasive. Current market data shows gross rental yields consistently hitting between 6 and 9.5%, completely free of any local UAE income tax. Then there is the currency advantage. The UAE dirham is permanently pegged to the US dollar. For international buyers, that provides a built-in hard currency hedge against local inflation. Contrast that with domestic Indian real estate. In premium markets like Mumbai or Bengaluru, rental yields often stagnate between 2 and 4%, paired with a depreciating rupee. But there is a massive complication missing from the marketing brochures. The UAE government will not tax your property income, but the Indian government absolutely might. Your specific Indian residency status dictates the final profitability of a Dubai investment. The legal framework splits buyers into two distinct profiles: the non-resident Indian, or NRI, and the resident and ordinarily resident Indian, the ROR. Real estate promoters frequently blur the lines between these two groups, marketing zero tax benefits that legally apply to only one of them. Treating Dubai as a universal, one-size-fits-all tax haven is a dangerous oversimplification. Buying in blind can cost unprepared investors millions in unexpected taxes and severe regulatory penalties. For NRIs, the funding path is frictionless. Using an NRE account, they face no remittance caps when sending capital to the UAE. Because they can move unlimited capital, NRIs can execute immediate full cash purchases of premium assets. This allows them to cross the 2 million dirham threshold required to secure a UAE Golden Visa. Resident Indians face a vastly different reality. Moving money out of India requires navigating the strict federal regulations enforced by the Reserve Bank of India. Resident Indians are bound by the Liberalized Remittance Scheme, or LRS. This places a hard legal cap of $250,000 per person per year on all overseas investments. This flowchart maps capital movement. The NRI path flows seamlessly to Dubai. The resident Indian path hits a $250,000 regulatory wall. This forces a trade-off: buy entry-level properties or utilize multi-year payments to spread capital. However, couples can pool allowances, deploying up to $500,000 annually. Even managing these limits, resident Indians face a major friction point: a 20% tax collected at source, or TCS, on foreign remittances. When outward remittances exceed 7 lakh rupees annually, your Indian bank automatically deducts this 20% slice. To be clear, TCS is not a final tax. It is an advanced tax credit held by the government, which you can claim back when filing your Indian tax return. However, the immediate cash flow consequence is severe. Resident Indians must maintain significantly higher upfront cash reserves to cover that 20% deduction while waiting for refunds. For a resident Indian, buying property in Dubai is an exercise in managing liquidity constraints. It requires meticulous planning across multiple financial years. Let's address the marketing claims. The Dubai Land Department and UAE government charge 0% on personal rental income and capital gains. If you are an NRI who qualifies as a UAE tax resident, meaning you live outside India for 183 days or more, your Dubai rental income remains entirely tax-free globally. This zero-tax environment provides NRIs a passive income engine that far outpaces domestic Indian properties. The resident Indian tax reality is completely different. Brokers often cite the India-UAE Double Taxation Avoidance Agreement, the DTAA, as proof resident Indians won't be taxed. That marketing pitch is actually a dangerous trap. The DTAA prevents you from being taxed twice on the same income, but because the UAE taxes that income at 0%, you generate no foreign tax credit to offset your liability back in India. Look at this comparison. Resident Indians add Dubai rental income to global earnings, paying Indian income tax at standard slab rates. This reshapes the calculation. A lucrative 9% Dubai yield drops to a net 6% after Indian taxes. There is also a strict ongoing compliance burden. Resident Indians must declare their Dubai property annually in their income tax return under Schedule FA. Failing to declare overseas real estate triggers the Black Money Act. The Indian government pursues undisclosed foreign assets very aggressively, and the penalties include heavy fines and potential prosecution. For a resident Indian, a Dubai property is a fully taxable, heavily monitored offshore asset. The illusion of an invisible tax haven simply does not exist for RORs. The ultimate decision comes down to your specific fit to the market, not just the quality of the real estate. Let's map your profile. Profile 1 is the NRI optimizer. You already live and work outside of India. The recommendation here is a definitive buy. The combination of unrestricted capital flow and legitimately tax-free yields maximizes your wealth generation. For NRIs, hitting the 2 million dirham property threshold unlocks the 10-year golden visa, securing your long-term residency and lifestyle completely independent of corporate sponsorship. Profile 2 is the ROR diversifier. You live, work, and pay taxes in India. The recommendation for resident Indians is to hold or plan carefully. You must reset your expectations around taxation and upfront cash requirements. There is a valid strategic reason for an ROR to invest, accepting a lower net yield in exchange for a legal currency hedge against a depreciating Indian rupee. Do not attempt to bypass these rules. Utilizing informal channels like hawala or artificially splitting transactions to dodge RBI reporting requirements carries massive legal risks. You must maintain a pristine audit trail. Hire a cross-border CPA to manage your Schedule FA declarations and ensure your bank uses the correct purpose codes for every single transfer. Dubai real estate remains a powerful wealth engine, but it only delivers its full tax advantages if you align your strategy with the legal realities of your residency.